coming off of a winning day on Wall Street with the Dow hitting a fresh record close. Investors looking to hold on to this bull market as the Fed considers its next policy move. Here to discuss the markets and his investment thesis, we've got David Wagner, who is the portfolio manager over at Aptus Capital Advisors. David, always a pleasure to grab some time and get your perspective on these markets. I mean, we teed up some fresh record highs for you to chime in on here, David. So where does the momentum continue to persist from your perspective here?
Yeah, Brad, thanks so much for having me back. You're exactly right here. I think the market's seen between 46 and 47 new all-time highs this year. But one of the coolest things that I've seen about the market, not just over the past few weeks, but basically over the past third quarter, is that we continue to see new highs from different Ys. I mean, there's no secret that the market, as measured by the S&P 500, was led by the Magnificent Seven stocks for basically the last, call it, 18 months. But during the third quarter, we really started to finally see the market broaden out. You saw some of the more relatively undervalued areas of the market start to perform well. So think US small caps, think international, think EM. And from my perspective, it's almost like investors are speaking out of both sides of their mouth, because when the Magnificent Seven was running, everyone said, hey, you know what? The market's going to start falling right when the Magnificent Seven falters. But now I'm getting a lot of questions like, hey, Dave, is this still very much a bull market now that the Mag 7 names aren't running and is kind of being buoyed by the residual remaining 493 stocks? And I'd say that's ludicrous. I mean, look at the data. We're very much in a bull market right now. And when a bull market tends to hit its second anniversary, which we just did the last week, you tend to see the average bull market lasts about 5 years. Though I would say the third year of a bull market does tend to be a little bit more volatile than normal, but it tends to mean, the path of least resistance continues to remain to be higher.
And so what is your thesis amidst all of this, especially during an earnings season where the clear theme over the past several quarters has been artificial intelligence, but is there a new theme that you expect to emerge, or is it back to business as usual, focus on not just what took place in the most recent quarter, but also growth and which companies are talking about earnings growth?
Yeah, I think it's back to business as normal. I mean, like I said, this whole new breadth of the market is such an eye-opening experience for me because I am a small cap value active ETF manager. So I love seeing it on this side of things. But, I think probably to quote Animal Farm, some animals are created equal, some are created more equal. I think when you start to head into kind of the third, fourth, fifth year of some type of bull market, I think it pays to own more quality. It pays to own companies that have, operating leverage. It pays to, own companies that have pricing inelasticity, long runways of growth, and more importantly, profitability here right now. So I think those are the areas of the market that I'm really excited about looking forward.
And so with that in mind, your sector, where is the top quality sector that you're seeing kind of a basket of companies really showing that they can kind of check off the entire list of parameters that you're laying out that needs to be met in order for them to really get that quality annexation?
So I love barbelling stuff, Brad. So let me barbell this for you. And I'm going to go one consensus and one out of consensus view here. I think the consensus view here is that you have to continue to love the technological space. I mean, when it comes to me, like the thing that could really derail this market moving forward is some type of slowing in growth or some type of contraction in the operating margin of the S&P 500. And no sector shows and highlights this better than the tech sector itself. There's so much operating leverage associated with the entire sector, or even the tech proxies like in Amazon, what they have on the retail side, what you obviously have with NVIDIA, what you have with Microsoft. I think you have to have that be the bellwether sector of your portfolio. But I would barbell that actually with somewhat the industrial sector, because I think there's a lot of high quality companies there that have growing top line, that have growing margins right now that a lot of people would probably just push off to the side because, they would expect that we're heading into the latter half of some type of business cycle, and industrials are going to be more CapEx focused. They're going to be more cyclically oriented, and that they may, get hurt if the economy starts to falter at some point. But there's so much capital really flowing into just the infrastructure of America, not just on the AI side, but on the electronification of the U.S. grid side, that there's some really cool special plays out there where you could barbell, the tech sector as the bellwether cornerstone of your portfolio from a sector perspective, but then get a little style and flair with the industrial side.